Hey, hi, this is Kribakaran Rajendran, founder of Algo Trading from squareofbots.com. So, in this video, we'll be discussing about individual stocks versus index funds. So, basically, people know who wanted to trade, what they do is they backtest certain strategies and they read out multiple trading strategies and they implemented it. But when it comes to investing, most people don't give much importance. Like, for an example, either they opt for some mutual funds or they try to invest based on some fundamentally strong stocks. I myself have spent so much of time in creating an investing methods as quantitative investing methods. Like I have tried finding out what is the best way to select stocks for long-term investments and know whether it is good to buy 52-week high stocks or 52-week low stocks for investment. Or when it comes to SIP, I tried multiple researches like what is the best approach for SIP investment methods. Should I need to invest when market corrects, or should I need to invest every month, or do I need to wait for markets to correct 10% or 20% and then only make my SIP investments? So likewise, I have done multiple researches for investments specifically for SIPs, but in spite of all this, I have finally concluded to stick to index funds. So index funds is not only for people who are not aware about markets. I'll tell you in this video why I have opted for index funds, specifically for long term. So all my SIPs that I do on a monthly basis is only for index funds. I'll explain why I moved from individual stocks investing to index funds. So we all know Warren Buffett is one of the richest investors in the world, where he started investing at the age of 13 and now he is more than 90 years old and still he holds large chunk of individual stocks, which has given him multi-billion returns. But if you observe closely with respect to Warren Buffett's portfolio, earlier during his early age, they used to Berkshire Hathaway used to hold hundreds of stocks. And Warren Buffett and Charlie Munger during an interview, they themselves has told that their 80% of the overall returns or wealth that they have generated has come from less than 10% of the holdings. So just very few stocks has given them an outstanding returns, but still they do not know which stock is going to outrun on the long run. So they used to invest in a multiple diversified portfolio of stocks. And Warren himself has mentioned in one of his interview that if you look closely, like last 30 or 40 years of Sensex, if you have taken it, and people who have invested in Sensex during his early time and now, if they have still hold on to that position, they would have made huge returns. That is obvious. But if you look closely, it is not how many number of years that you hold on to a stock that matters. It is all depends on how you react on few months of those overall periods. Say for an example, it doesn't matter whether you're holding a particular investment for 40 years, but what matters is how you have reacted in few months when market crashed or when market moved adversely. For an example, how you reacted during dot-com bubble crash, and how you reacted during 2008 global financial crisis, and how you have reacted during corona pandemic of March 2020. So all these periods are different events. And for an example, 2008 global crisis actually vanished most of the large enterprises. Companies like Lehman Brothers, which were there for hundreds of years, has gone overnight. And during 2020, during corona pandemic, nobody knows what this pandemic is going to do, and it affected multiple industries, but still every single event like this is completely new. So definitely these kind of events will create panic among investors. So seeing your portfolio going down 50%, so whatever the stocks that you hold, it's going to get corrected at one point of time, and seeing your portfolio of stocks going down 50 or 60%, and you compare that with your index and you lose your confidence in it, you lose your conviction in it, and you tend to panic. So obviously we never know how we would react during those panic times, but it all depends on how we react during these panic times determines your overall profitability in the long run. So let's consider you are an investor in companies like DHFL and S Bank. So these companies were actually part of Nifty 50 back then, but these both the companies crashed more than 40% in one single day. So how you would have reacted if you are holding a stock and individual stock like S Bank and DHFL and seeing both the stocks crashing more than 40% in one single day, how you would have reacted? On that day when it crashed 40%, the actual news of why it crashed was not out. So it took so much of months and times, and eventually, they came out stating that DHFL has these loan issues, and eventually they went bankrupt. And S Bank was also losing more than 90% over the period of time. So we retail investors, by the time we wait for the news for the confirmation, the stock would have already affected. Like if you have did SIP investments on these individual stocks, and no, say suppose you invested 10 years or 15 years of your savings in these individual stocks, and suddenly overnight, due to some issues, or due to the management issues, or due to some issues in the company, if these stocks crashed 40 or 50%, all your long-term investments would have wiped out overnight. But why I have come out of these individual stocks to move to index funds is because of the comfort zone that it gives me. So when you invest in index funds, it gives you a lot of comfort zone. You don't tend to panic. First thing is, we always as an investor tend to compare our individual stocks portfolio with respect to index. Say suppose if index crashed 20%, but if your portfolio crashed 50%, then you would be really sad, because your overall portfolio is much down than the actual index. So this is when people tend to doubt their overall investments portfolio. Should I hold on to it? Should I need to exit it? So all these confusions will come. So why I have opted for index fund is, see, I wanted to commit myself with respect to long-term investment, not just for 5 years or 10 years. I wanted it to be for at least for 30 or 40 years of period. And even after my period, I wanted to give all these investments to my kid, to my son or daughter, and then I would ask them to continue the same index fund investing. So what happens is, over 1 or 2 generations, the wealth that is created through compounding effect, when you continue to regularly invest every single month, even with respect to 12% returns over a period with respect to index funds, that is going to give you huge returns. But all it matters is whether you are able to stick to this monthly habit of regularly investing every single month. So you need to ask yourself. So when I do with respect to stocks, when I tend to doubt myself, when I tend to doubt my investment model, or when I tend to doubt my systematic investment approach, which I do every month with respect to stocks, the first thing I do is I stop it. I stop investing in it, or I try to withdraw from it, because of the lack of conviction. But with respect to index, we know eventually it is going to go up in the long run. So the point that I wanted to convey is, picking a specific stocks and investing them for a longer period of time, for an example 30 or 40 years, is really a difficult task. You can look back and see how many of the stocks which were considered to be one of the best stocks, one of the best blue chip stocks, are not relevant today. Companies like Kodak, which completely went out of relevant now, and companies like IBM, which are supposed to be one of the best companies like General Electric, General Motors, these were the companies which were there for many hundreds of years, and still these companies are not relevant anymore. So the company that we see which is best today might not be the best companies 20 years, 30 years down the line. It keeps changing, so there will be new companies that keeps coming in. So for an example, Amazon was not in the top 10 list like 10 years before, because of the lower internet penetration. Now internet penetration is higher, because of which e-commerce companies were at the top. So likewise, so picking up companies, picking up stocks, and then getting committed to them and investing in them for a longer period of time really needs a lot of conviction towards your investment, really needs a lot of conviction towards that stock. Only then you would be able to stick to it. So consider this: Dow Jones, which was there for hundreds of years, like it started almost 100 years before, during 1890s or 1880s they started it, and almost for the last 100 years, if you see, what were the list of companies that were part of Dow Jones when it started? How many companies were part of Dow Jones at the time of launch? How many are still there in the index? If you see, there are only two companies that were part of Dow Jones 100 years ago still exist, which is General Electric and United States Steel Corporation. Only these two companies still exist. Rest of the companies are not there. So if a company is not there as a part of index, which means that it is not doing well. So only a company which does well gets added to the index. A company which does not do well gets removed from the index. So it's basically a momentum factor already built into the indexing part. So investing in an index is nothing but investing in the best companies. That's all. So you don't need to do too much of analysis in finding the best companies. Indexing itself is that process. It signifies that you bring in best companies and remove the worst companies. DHFL and S Bank, which were part of Nifty 50 has been removed now because they were not doing well. So companies which are doing well gets added to the index. So that is how index works. So by directly investing in index funds, you are actually betting in companies that are really doing well. So we saw that only two companies which were part of Dow Jones 100 years before still exist. Even if you consider 50 years, how many companies that were part of Dow Jones 50 years before are still in index? If you see that only 7 companies are there. Only 4 companies are still part of Sensex. Only 4 companies. So rest of the companies are not there. So when an index is formed, they have certain best companies and then they create that index, and eventually they remove the worst companies and keep adding the best companies. So currently with respect to Sensex itself, only 4 companies are there which are still part of Sensex, which were created 40 years ago. So as Warren Buffett says, no, it doesn't matter how fundamental the company looks like. It doesn't matter how much effort you put in to pick the best companies based on various parameters. But at one point of time, even the best companies can be run by some fool eventually who come into the management, who could ruin the overall business reputation of the company, who could bring down the stock prices of that company by taking improper decisions. So those things are not in our hands. So anything could go wrong with respect to individual stock pickings. So even if you consider the statistics like fund managers, how many fund managers out there in the world? So they have immense resources, they have very good knowledge compared to compared to retail investors, but still 85% of the fund managers were not able to beat the normal index returns over the long run. So that is what the stat says. Doesn't matter how complex your models are, how robust your trading, how robust your investing models are. When at times of unknown events, we tend to panic. That is what the human nature is. But when I invest in index funds, it gives me sense of peace of mind. Like I don't need to worry constantly. And second thing, I don't need to worry what no particular management is going to do with the stock, or how their product is going to be relevant or not. Like for an example, 10-20 years before, whatever the companies which were considered to be the best are not best now. So we can't predict what is going to be the best business 20 years down the line. So when we have so much of uncertainty with respect to individual stock picking, it is best to stick to index funds. So what happens is when I'm investing in index funds, it becomes an habit much easier. So making and investing as an habit is really hard, but when you do with index funds investing, the habit becomes much easier because you don't need to analyze which funds to invest in. I directly invest in Nifty 50 index fund and next Nifty 50 index fund. So UTI index fund is what I used to invest in, or people can invest in Nifty Bs or Junior Bs. So you have ETFs and you have index funds. You can invest in any of this, and the good part is people who are actively trading, they can pledge their SIP investments. For example, every single month I used to invest 10 to 20% of my monthly income into these index funds. And what happens every single month when I invest, I pledge them, which automatically increases my trading capital. So I pledge them and use it as a collateral for my day-to-day trading. So which automatically increases my trading capital on the long run slowly and steadily. So you have SIP investments which indirectly helps you your trading capital as well. So that is an added advantage. When you invest in stocks, the haircut is larger. For an example, if you have bought 1 lakh worth of stocks, when you're trying to pledge it, 20% or even 30% might go with respect to some stocks based on how volatile the stock is. But when you're investing in an index funds, the haircut is just 8%. So when you're investing 1 lakh, you almost get 92,000 as collateral. So which is really a good point. So I'm seeing that people compare, okay, index fund is fine. What if in case the index fund doesn't give you returns for a longer period of time? They take an example of Japan Nikkei index. But what they forget is, if you take Japan Nikkei index for the last 20 years or 25 years, it is it's flat. It did not give you huge returns. That I accept. But before it is giving flat returns, it gave phenomenal returns between 1945 to 1990. During those period, it gave almost 16.4% of CAGR returns. So an index that is giving more than 16% returns, when you compare that with across all other world markets, that was the topmost highest returns that has been given by any index. So due to this bubble where that happened in Japan, it gave phenomenal returns for multiple decades, and eventually the bubble burst, and they are stuck in a range for the last 20 years. So these things could happen, but when with respect to Indian index, we are not in a bubble at all. We haven't seen phenomenal returns, outstanding returns like what we have seen in Japan. If you closely observe all the purchasing decisions or the spending decisions that is being done with respect to current economy, is done between the age of 25 to 35. These were the people who are working professionals who started making good money, who has this purchasing power. They are the one who decides the economy. And if you consider across the globe, which country has a maximum people between this age of 25 to 35, that is India. So no other nations, no other countries has the highest populations between this age. So this is going to determine the Indian economy eventually down the line. So by investing in index funds, obviously we are betting in Indian economy. That is going to help us in the long run. No, because compared to what we have seen in the past, say suppose from last 20 or 25 years, what we have seen versus what we are going to witness in the next 20 or 25 years is exponentially going to differ, because of the internet penetration. Half of our populations has got internet access, and we know that they always say internet is the future, and we could literally see that. So how many of you would have thought that we could go for an haircut and pay via phone? How many of you would have thought that we could go to a pani puri shop, eat a pani puri and pay through a mobile app? So these are the technology advancement that we started seeing with respect to Indian economy, and this is going to advance to a much higher level. So many investors who lost investing opportunity with respect to China are betting on India right now. So that is why we could see huge inflows with respect to Indian markets. You could see literally thousands of crores coming in every single month through SIP routes. There are two books which gave me huge conviction to move from index funds. One is The Psychology of Money by Morgan Housel, and the other book is Just Keep Buying by Nick. So these two authors played a vital role in for me to making a decision from moving from individual stocks to index stock. If you are investing directly in stocks, ask yourself whether the company that you are investing in or the stocks that you are currently holding will still exist after 30 or 40 years. Whatever the business that they are currently running, will it be still relevant after 30 or 40 years? So if you really have convictions, then you can continue with your stock investments. Otherwise, it's better and much safer to invest in index funds. So when people say that it is safer in index funds, it is not that you are going to get zero risk. The risk will always be there. The market risk will always be there. But the kind of fluctuations that you see with respect to individual stocks and with respect to index will always be relatively much lesser. So that is why I know that is what I wanted to convey in this video. So now if you guys have any questions, please post in the comment section. I'll address it. Thank you.